Hey everybody, John here. So if you're looking to take advantage of the stock market and the fact that it's doing really well and don't really know how to get involved with it, I want to give you an idea about creating your own investment funds. Doesn't take much to do, and let me show you exactly why you want to do this. Here's a real basic example. Let's say we got General Electric, we got Walmart, we got Amazon, we got Dow, we got Tesla, and we got Ford. Okay? Now, let's say for the sake of argument that you want to buy, you get in onto something like Fidelity or something, and you're going to buy a fund that they've already put together for you. Okay? That fund maybe has, one of their funds has these stocks in it. Okay? The other fund maybe has these stocks in it. Okay? The other fund maybe has these stocks in it. The other fund maybe has these stocks in it. Okay? Now, and then maybe this fund actually, or maybe there's another fund that has these and another stock. We'll make it a Q stock for all you conspiracy idiots. Anyway, my point is, there's only so much good stuff going on in the stock market at any moment. So what happens is the various funds wind up being heavy in the successful stocks. So while you think that you've got a diversified portfolio because you own 4 or 5 different funds, it could be heavy in certain stocks. You could have half of your portfolio in 2 or 3 stocks. And I think that is, if you got the time, I think that's not a wise way to go. So here's what I did, and you can do whatever you want, but here's what I did. My stockbroker is Charles Schwab. Okay, I know that TD Ameritrade and E-Trade and a couple of other houses offer this, but what you're looking for is the ability to buy a fraction of a stock. Okay, you want to buy a fraction because these are the big boys. These are the $2,000 or $3,000 stocks. You want to be able to buy a fraction of that at any one time. So here's what I did. I took $500 and I looked at the top 3 business magazines that I look at: Forbes, Kiplinger, and U.S. News and World Report. And I found the articles that they had put out at the beginning of the winter, basically, that discussed the stocks that were expected to sail in 2021. And I identified 50 of those stocks, and I took $500 and I bought $10 worth of those stocks. So if you were to look at my portfolio, you'd see on day 1, 50 entries. The top bunch would be green, the lower bunch would be red, and that would be based on the performance of the whole market on that day. Now what I did was I went back a week later, and some of these stocks had gone up, and some of the stocks in the middle had done nothing, and some of the stocks had gone down. And a $10 stock, or $10 worth of a stock that goes down to $9 is a loss of 10%. That's pretty substantial. So what I would do over time is I would look at the bottom ones, figure out what their loss was, and then, like I said, if a stock had lost 10% or more, I sold it and took that $1 hit and then bought more of what's up here. Okay? So slowly I'm paring the bottom ones off. And it's funny, the ones that weren't successful this year were like FedEx, Tesla, Home Depot. These are all good companies that you'd think, oh, I should invest in and hold. But they're not doing as good as like Hilton and General Motors and Berkshire Hathaway and US Bank and some of the health stocks. So that's what I got going on up here. And basically today, I wound up clipping off my last in the red stock. So now my portfolio is all green and showing a profit or a percentage of anywhere from under 1% on some of the lower stuff to, I've got some stuff that's, 20%. My IRA is showing a 15% return this year, and my just regular stock portfolio is showing about an 8% return. So now that I've got my fund sort of dialed in and it's all in the green, I'll heavily populate it with a couple of bucks and divide that evenly amongst what I've got there. So that's what I did. If you have any questions, let me know. Otherwise, we'll talk to you later. John out.